Welcome to the Explainer. Today, we're looking at two undeniable tech titans that have, well, somehow been completely left in the dust during the recent market bull run. But if you look beneath the surface, they're hiding some absolutely incredible underlying value.
Let's start by confronting a feeling I'm sure a lot of us have had lately, and that's the fear of missing out. Did you miss the great tech rally? Because right now, while the herd is just blindly chasing momentum stocks, the absolute best opportunities might actually be the ones everyone else is completely ignoring.
To understand why a giant like Microsoft is suddenly struggling, we've got to talk about a dramatic market event Wall Street is currently calling the SaaSpocalypse. Basically, it's a massive market rotation. Capital is aggressively fleeing traditional software stocks and pouring straight into semiconductors and memory chips.
So major software companies are getting left behind. And it's not necessarily because their business models are broken, right? It's simply because the big money is changing its address. It's moving rapidly away from software leaders and piling into hardware.
For Microsoft, this fall has been incredibly tangible. I mean, they dropped a massive 30% from a record high of $555.45 back on July 31st, 2025, down to just $390 by July 6, 2026. That is an undeniable, brutal haircut for literally one of the most powerful companies on Earth. But here is why that drawdown actually matters to your wallet. Because of that massive drop, Microsoft is now sitting at a PE ratio of just 24. For a tech titan of this scale, that kind of valuation is incredibly rare. It makes Microsoft the absolute cheapest it's been in recent memory, and for sure, the undisputed bargain among all the Magnificent Seven stocks.
So what exactly has Wall Street so spooked? Well, it boils down to three things. First, investors are losing patience with Microsoft's massive AI spending. They want to see the return on investment yesterday. Second, to fund that AI pivot, Microsoft announced a really painful restructuring, slashing thousands of jobs in its Xbox division. And third, there is growing market anxiety over just how expensive it is to operate these super complex frontier AI models.
And you know, CEO Satya Nadella has actually amplified some of this anxiety. By acknowledging those high operational costs, he signaled a major strategic shift. Basically, Microsoft is deliberately moving away from its expensive reliance on OpenAI. Instead, they want to promote lower-cost, much more flexible AI alternatives. It's a pivot that makes total long-term sense, but yeah, it's undeniably causing some short-term friction.
But hold on, when you look past the scary headlines and structural pivots, what's actually left? Under the hood, Microsoft is still an incredible business. They maintain a pristine balance sheet, and despite all the noise in the market, they continue to post proven, steady growth. This underlying strength is exactly why a lot of Wall Street analysts view this 30% pullback not as a red flag, but as a prime buying opportunity. For long-term investors who truly believe in Microsoft's cloud infrastructure and its eventual AI monetization, this dip is the exact setup you wait for. All right, let's shift gears to our second giant, Meta. $125 to $145 billion. That staggering number represents Meta's newly raised 2026 capital expenditure forecast. And this is driven almost entirely by enormous infrastructure needs and sky-high memory chip pricing. But this heavy spending triggers what we call the capex fear. See, investors are completely haunted by the billions Meta previously poured into the metaverse, with essentially zero return to show for it. So they look at this new, massive spend and immediately panic that history is just repeating itself. Plus, Meta has a really unique vulnerability right now. Unlike competitors such as Google, who have these massive cloud divisions to rent out excess computing power and quickly recoup expenses, Meta just lacks that built-in safety net. They don't currently operate a massive cloud computing arm to instantly offset these crazy infrastructure costs. This cash flow fear got so intense recently that Meta stock actually tanked on pure speculation, just wild rumors that the company would need to take on more debt just to fund this infrastructure. Management stepped in firmly to debunk that talk, but man, the market remains incredibly skittish. Now, to offset these fears and prove they aren't just burning cash aimlessly, Meta is aggressively exploring some really unexpected high-return avenues. We're talking rolling out new subscription plans for its platforms, building a Reddit clone, and get this, even developing a betting platform. But the absolute most fascinating initiative is something internally called Meta Compute. That last point is a potential game changer. Meta Compute is an internal cloud infrastructure business. It finally gives Meta a way to monetize their spare AI capacity, essentially building that very safety net that competitors like Google already enjoy. If they pull this off, it could produce truly massive returns for the company. So when we step back and look at the big picture, the potential upside for both of these deeply discounted giants is just hard to ignore. Microsoft sits at a remarkably cheap $390, but analysts are targeting $600. Meanwhile, Meta is currently at $600, but is totally poised to hit $1,000 for patient investors who still believe in Mark Zuckerberg's ultimate vision.
As we wrap up this explainer, I really want to leave you with a final thought on these two underappreciated stocks. In a market constantly obsessed with tomorrow, are you patient enough to reap the rewards of the future? True value often requires the kind of patience the broader market just doesn't have right now. Thanks for learning with me today, and keep looking for those opportunities everyone else is completely missing.